And I think there should be a beep. Are we good with the recording?
Yes, it's being recorded.
Okay, thank you. So then let me introduce the webinar, the organization, and our presenters. So again, the webinar is Investing in the Age of Climate Change, and I want to just say a few words about the Mayor's Innovation Project. We are a peer learning network for mayors and city staff nationwide. And the Efficiency Cities Network is a peer learning network for staff, researchers, and NGOs around the country focused on efficiency in local government in various forms. The role of both of these networks is to share best practices and bring you innovative policy ideas and speakers, which is what we're doing today. If you are interested in either one of these networks, the Efficiency Cities Network is at efficiencycities.org, and the Mayor's Innovation Project is at mayorsinnovation.org, and we'd be happy to answer any questions you have about the organizations and have your cities be involved in both or either one. Let me now introduce our speakers. I'll introduce both of them just at the top to get that done, and then we'll go into the presentation. So our first speaker will be Alex Bernhardt, who is Principal and Head of Responsible Investment for Mercer in the US. Alex is a noted expert in environmental, social, and governance risk assessment and management, and was a core contributor to Mercer's 2015 Investing in a Time of Climate Change report. He has since co-led climate change-related consulting engagements for asset owners in North America and regularly advises institutional investors of all types and sizes on issues related to sustainable investment governance and portfolio risk assessment. After Alex, we'll hear from Stephen Feit, who's an attorney at the Center for International Environmental Law's Climate and Energy Program. His work focuses primarily on climate liability and finance, specializing in developing legal strategies to hold fossil fuel companies accountable for the impacts of climate change and for failures to acknowledge climate risk, something which is particularly relevant this week. Stephen also works on issues of securities law and finance to accelerate the incorporation of climate risk into financial markets and disclosures. He was a primary author of the $1 Trillion Transformation Report, the foundation of the discussion that we'll be having here today. Thank you both so much for being here with us. And Alex, I will hand it over to you to start the presentation.
Excellent. Thank you very much. I am going to get this screen share to work. Hopefully. There we go. Thank you so much, as I said, Satya, for introducing me. I'm very happy to be here today, and I hope we'll have a very engaging discussion toward the end. I'm going to give a brief overview of Mercer's contribution to the $1 Trillion Transformation Project, and you'll see a little bit more about what that entailed briefly. First, a brief commercial. Mercer is a investment consultant, the largest investment consultant in the world. We have many other lines of business as well. Our responsible investment team, where I sit, sits within the investments business. We have over $10 trillion in assets under advisement globally, and a number of other services and products as well. And it's in this capacity as an investment consultant that we're speaking here today. I'm the responsible investment business leader for Mercer in North America. We have specialists in our group all over the world, which enable us to learn from one another and best practices in Europe and Asia and the US and vice versa. We also were a founding signatory to the UN Principles of Responsible Investment, which is an important initiative that many of you may have heard of before in the investment industry, that focuses on incorporating environmental, social, and governance factors into investment programs for pensions and insurance companies and other asset owners. So that's a brief commercial. Today, what we're going to talk about is specifically the role of climate change risk management in U.S. public pension plans. And our focus for this research was on defined benefit pension plans. We do recognize, however, and want to recognize up front that in the U.S. municipal finance arena, there are a number of other financial vehicles or entities or structures that warrant could be addressed, in which climate change could be addressed as well. Treasury departments, municipal green banks, defined contribution plans, et cetera, all matter. But again, our focus here today will be on defined benefit plans. Happy to have a subsequent webinar talking about the other areas as well, perhaps. But our collaboration with the Center for International Environmental Law, which has been referenced already now twice before, the TDT for short, $1 trillion transformation, is really an educational initiative. Our aim is to target public pension administrators and trustees, and to get them up to speed on the financial impacts and financial tools available to analyze climate change risk, and also to discuss the legal challenges. And I'll be discussing the financial aspects of climate change now. So the first element of climate change risk management, which I think is important for public pensions to recognize, is good housekeeping. Basically, it's making sure that your governance approach, your governance processes have provide a clear framework from which to analyze and manage climate change risk going forward. And we have, over our many years of working with asset owners of all types and sizes in the space, have developed a process. We call it our framework for sustainable growth, which we've summarized here. But basically, the foundation for any such action really is a strong articulation of a set of beliefs that ESG factors or climate change, or a specific set of systemic risks like climate change, can drive investment outcomes and should be taken into account. And once those beliefs have been articulated, you can then update your investment policies and processes, and then eventually that will organically evolve into portfolio shifts as well, where you're then allocating, say, to sustainable investment options in your investment program. And so that's a very high-level overview of how we progress climate change risk management from a governance standpoint. So once you've got that good housekeeping in order, it's then, we think, possible to address climate change as a risk, as you might any other large-scale portfolio risk. And here we have the cycle, the risk management cycle on the right of the chart, showing the various phases of risk management. So identify the risk, assess the risk, manage the risk, and monitor it. And we'll go through at least the first three elements of the cycle here now. So how can you assess this risk? And before we go into that, I'm going to talk a bit about why we think climate change is material, a material financial risk for investors to consider. And irrespective of the dread physical impacts that climate change may cause in 10, 20, 30, and longer time frames out from today, there are a number of market forces at play today which really necessitate the addressal of climate change in investment portfolios. For instance, we've seen over the last few years renewable energy investments reach all-time highs. I think in 2015, about $350 billion was invested in renewable energy, and the percentage of new energy capacity installs dedicated to renewable sources, excluding hydro, is now over 50%, I believe, and those are all Bloomberg new energy finance numbers. Fossil fuel divestment campaigns are growing in their urgency and in their noise. Now $5 trillion worth of asset owners, or as of about 8 months ago, $5 trillion worth of asset owners globally have now divested of some form of fossil fuels. There's a growing amount of regulatory agreement and scrutiny on fossil fuel investments. There are now something like 2,000 laws globally focused on climate change, and of course, oil price volatility continues to be a concern for fossil fuel reliant or carbon intensive sectors. And then, as we've seen in the last couple of weeks, shifting extreme weather patterns and the threat of climate litigation also loom. And so for all of these reasons, only a few of which really relate to the underpinning physical impacts of climate change, there's a need for trustees and investors to really start to consider climate change and put it onto their risk registers and onto the radars more generally. Climate change, however, challenges current risk management systems. It's not a unilateral risk. It's a very multifaceted risk, and it impacts an investment program in many different directions. And so for that reason, we recommend doing a whole number of risk assessment approaches as possible. You can look at the risk from a bottom-up perspective, so by doing carbon footprinting of your portfolio, for instance, to see where which assets are most exposed to carbon taxes or other carbon risks. And then you can also do top-down analyses. And what I'm going to talk about here today is Mercer's proprietary asset modeling approach, which we developed in 2015 with a group of large investors from around the world. And this is a real top-down approach, and it involves the asset allocation modeling and allowing investors at that topmost decision in their program to really integrate the consideration of climate change into their asset allocation decision, which is really the foremost decision that most defined benefit pension plans make in constructing their portfolios. And so in order to develop this model, I'll just speak briefly about the underpinnings of it. We have a very long set of papers which describe the actual technical approach that we've used to analyze this risk, but hopefully the short overview will suffice for now. What we recognize is that there are a range of potential climate change outcomes that could occur, and what we ended up modeling for our portfolio was a 2-degree, a 3-degree, and a 4-degree scenario. 2 degrees really aligns with the universally agreed sort of quote-unquote safe level of climate change. 3 degrees, of course, is more in line with our current trajectory based on nationally determined contributions to the Paris Agreement. And then 4 degrees is severe climate change where physical damages would be expected to be much higher. We then also recognize that in each of these scenarios, the percentage of risk associated with the transition to a low carbon economy, so transition risk, will be higher in lower degree scenarios, whereas physical damage risk is going to be higher in higher degree temperature scenarios. And so we were able to quantify the various levels of impact that these transition risks and physical risks will have on industry sectors and asset classes. And it's those inputs to the model that really inform the outputs, and we'll describe what those look like here shortly. In short, we describe the scenarios numerically with deterministic pathways. So each scenario has a numerical underpinning, and then our climate risk factors manifest as a heat map effectively. So you can see each sector's and asset class's vulnerability to each of the 4 risk factors, which we call the TRIP factors, or technology, resource availability, the impacts of physical catastrophes, and policy risk. And happy to speak more about those in the Q&A if there is interest. Here is the sample portfolio that we modeled for the $1 trillion transformation report. This is a typical U.S. public pension portfolio. You can see about 50% in equities, about 20 or so percent in debt, 25% in debt, and then about another 25% in alternatives. A pretty typical growth-oriented investment portfolio. We ran that through our model and were able to produce a range across the 4 scenarios that we modeled, a range of asset class level outputs. And what you can see, infrastructure, for instance, has a maximum potential impact of 80 basis points at the mean return level, and a minimum impact of negative 20 basis points, depending on the scenario that comes through. And you can see similar levels of variance for other asset classes, in particular those that are invested in, say, the real economy, or real assets. So agriculture, timber, real estate, and infrastructure stand out there, as do emerging market equities. And so, having quantified these asset class level outputs, we're then able to pull that together for the total portfolio. And what you can see is the circle chart here, which is it's essentially a visual tool, a way to enable an easy view of the impact of climate change on a portfolio. And so if the colored bar moves into the circle, that signifies a negative impact, and if it moves out of the circle, that signifies a positive impact to the asset class. And overall, you can see that the net impact is broadly going to be neutral, if slightly negative on this portfolio, because most of the asset classes, certainly the largest ones, U.S. domestic equity and developed market equity, are going to experience some return drag, we think, in a 2-degree scenario, which is what we're showing here, whereas emerging market equities and the real asset classes, infrastructure, timberland, ag, and real estate, are going to experience a gain. And so those offset each other somewhat at a total portfolio level. But what I think is really interesting is that because there are winners and losers, there's an opportunity within a 2-degree scenario to really hedge your risk and or to capture opportunities from the low carbon transition. Whereas if you look at our 3-degree and 4-degree scenario outcomes, which are on the next slide here, you can see that most of the impacts are either neutral to negative. So there's not really much upside in those scenarios to financial markets, at least not as they're currently constructed. And so, the risk management strategy that you might evolve to address a 3-degree or a 4-degree outcome is going to be much different than for a 2-degree outcome. And then here you can see as well, this is a simple way of looking at the total portfolio impact in financial terms. And you can see that this particular portfolio is actually least resilient to a 2-degree outcome. Hence the redness of that particular column. Whereas in the 3-degree and the 4-degree outcomes, it's somewhat mixed. And so in this context, the final takeaway for the pension would be, okay, well, we're not well positioned right now to withstand a 2-degree scenario. Our portfolio is heavily invested in fossil fuels and other stranded assets, which might be subject to stranding in a low carbon transition scenario. Do we think a 2-degree scenario is likely, and if so, how are we going to manage that risk? And so it allows pensions to really ask those questions and have an appropriate answer to them. And there are, suffice it to say, there are a number of other methods of risk assessment which can be used to supplement this top-down analytical method. I won't belabor those here now. Once you've developed your risk assessment approach, there are a number of ways to manage the risk, and we've categorized portfolio actions into 3 different buckets here: the reallocate bucket, the hedge bucket, and the engage bucket. And reallocation could include divestment of fossil fuels. Some fiduciary investors have elected to divest. It could also include investing in sustainability themed managers or with investment managers that are highly rated from an ESG standpoint, or really focus on environmental, social, and governance quality companies. You could also do, if your fund is large enough, you could do direct investing in sustainable assets like renewable energy projects, say. And then there's hedging, which you could do that synthetically with an overlay. So without even changing any of your positions in your portfolio, you could essentially buy a derivative which hedges your downside, or you could invest in low carbon indices. And then on the engagement side, there are a lot of very important strategies and approaches too that you can undertake to encourage portfolio companies and portfolio managers to really improve their climate change stances themselves. And it can be difficult in a risk management context to decide which of these actions to prioritize. And so here we have an illustrative graphic of charting each of these particular portfolio actions on two levels. So the x-axis shows the cost of the action or the disruption of the action to the current process, whereas the vertical axis, the y-axis, shows the degree of the directness of climate impact. So which has the most influence on the real economy or outcomes therein. And you can see that there's a wide range of potential outcomes you can take, and this is highly illustrative. Other individual plans may place these bubbles in different places, but the point is that there are ways to really prioritize these actions in a meaningful way. And so my last point that I'll hopefully leave you with here is that there are basically three different categories of investor that we've identified in our work with investors all over the world around climate change risk management. There are unaware future takers, aware future takers, and future makers. And future takers, we're all future takers to some extent, right? The climate is changing, and we are either going to prepare for that in the unaware future taker in the aware future taker camp, or we're not going to prepare for that, and that's the unaware wear a future taker can. And then there are a whole other class of investors, and we're seeing more and more investors adding themselves to these ranks that are orienting themselves as future makers and trying to influence the outcome that they want to see take place in the underlying economy in which they invest. And they're doing this through engagement with companies and with policymakers and other organizations to try to foment policies that are favorable to the climate outcomes that they want to see. And so there are a number of different modes of action that investors can take, and again, we encourage you to take a very thoughtful look at how climate change might impact your portfolio, and then to make a decision on which of these camps the pension should sit. And that's all I have, sorry, for now, and I'll turn it over to you, Stephen.
Thank you, Alex. Hold on one second. All right. Hi, everybody. My name is Stephen Feit. I'm a staff attorney at the Center for International Environmental Law. Since 1989, CL has used the power of the law to protect the environment, promote human rights, and ensure a just and sustainable society. So when we started looking at pension fund fiduciary duties, the core of the duty is the duty of prudence. Pension fund fiduciaries must act with the care, skill, prudence, and diligence that a prudent man in a like capacity familiar with such matters would use in the conduct of an enterprise with a like character and with like aims. Now, this duty gets subdivided into more specific duties, which we'll address in a moment. As Alex noted, climate change is a material financial risk, but it does not affect all industries, all asset classes, and all sectors the same. So while we can't make perfect predictions about what kind of financial impact climate change and policies relating to climate change will have, we can make reasonable predictions. These aren't, unknown unknowns. So the duty of prudence can broadly be subdivided into 6 specific delineated duties, and climate change in its own way triggers or implicates each of them. The first, the duty of inquiry requires a trustee to inquire into the relevant facts and circumstances surrounding investment decisions they make. So in the climate context, this is quite clear that trustees or fiduciaries should inquire into the ways that climate change and climate-related financial risk affect the investments they're looking to make. But it's not just enough to inquire at the time of initial investment. Fiduciaries also have a duty to monitor those investments, to periodically review those positions, to check on the prudence of maintaining those investments. Typically, this duty is construed to be an annual obligation, but there's a caveat that when a trustee knows or should know of information that would negatively affect the value of their investment, they have an obligation to review those investments. And so in the climate context, because of the nature and the speed of change in the regulatory space and the technological space, it's possible that a fiduciary's duty to monitor may be triggered more rapidly than they are prepared for without considering these issues. But those are both procedural obligations. Substantively, fiduciaries have a duty to diversify, which can also be thought of as a duty to minimize risk while maximizing returns. And another way to think about this is not taking on any uncompensated risk. So in the climate context, there's a tension here because, of course, since the 1970s, just the move has been to own as much of the market as you can, be a universal owner, but climate-related financial risk, as you saw several slides ago, really is concentrated in a number of sectors, a number of industries, and really presents a lopsided asymmetric downside risk. And so depending on your jurisdiction, some jurisdictions have a provision directly written into the authorizing statutes for their pensions. Others, it's developing case law, but essentially the duty to diversify applies unless it is clearly not prudent to do so. And so this, in the climate context, this has to be balanced against the concentrated risk, especially to things like fossil fuels and utilities. But the duty of impartiality requires trustees not discriminate between the interests of different beneficiaries, including future beneficiaries. So this is really critical in the context of a pension, because pensions, especially public sector pensions, are indefinite. They have no expiration date, and so they really do have to prioritize stability as a co-equal priority to growth. And so sometimes the duty of impartiality when talking about future beneficiaries is also thought of as a duty to preserve trust capital. And I bring this up because climate-related financial risk poses a number of risks. Some of them are more gradual over time, but there are also the possibility of rapid downturns. And so those kinds of sector industry crashes, those kinds of rapid diminutions of value of particular assets in particular asset classes or industries is exactly the kind of risk that the duty of impartiality counsels pension fund trustees and fiduciaries to protect against, because pension funds have to pay out month after month, year after year, decade after decade, and while a lot of pensions are currently struggling with their funding status as it is, the risk of a rapid downturn in asset prices is really quite threatening. Fifth is the duty of loyalty. Trustees must act in the sole interest of fund beneficiaries. Typically, this is construed as a prohibition against self-dealing. If you are a trustee of a pension fund, you probably shouldn't also sell the services of a company you own to that pension fund. But there are other ways in which the duty of loyalty can be triggered and can be breached. And one of them is pursuing goals that are in your interest as a trustee and not in the interest of your beneficiaries. And obviously this is quite awkward, but in the case of climate change, the issue is quite political, and there are reasons, and understandable reasons, why trustees in a given circumstance might either be wary to act on climate-related risk for fear of appearing political, but also would choose not to act on climate risk due to their own political perspectives. And in either of those situations, either would really be a violation of the duty of loyalty, just because trustees do have an obligation and fiduciaries have an obligation to act in the interest of fund beneficiaries and only in the interest of fund beneficiaries, and their concerns really can't factor into the equation. Finally, this one's pretty self-explanatory. Trustees and fiduciaries have an obligation to act in accordance with plan documents, but this is a good bridge to a discussion of what trustees and fiduciaries, but especially trustees, should do in the face of this kind of risk. I'm not going to discuss the substantive options in terms of reallocating and hedging and engagement, but from a legal perspective, there are two things I really want to stress. The first is a modification of plan documents. This can be a first step towards addressing climate risks, and it's really important for ensuring that trustees and staff and outside advisors and investment specialists are all on the same page, and that everyone understands what the priorities of the fund are and how to go about achieving them. But it's important to note that this really can't just be a cosmetic adjustment. If you include some language about valuing climate risks or something, but make no real changes to behavior, that doesn't address the procedural and the substantive duties that trustees and beneficiaries have, trustees and fiduciaries have to their beneficiaries. And if you make a more serious adjustment to your plan documents, you, as noted before, have an obligation to follow and to adhere to those documents. But secondly, monitoring effectively. Trustees don't make day-to-day decisions about what to invest in or where to put their money in. And a lot of times, even investment professionals aren't making individual decisions about which stocks they're doing more broadly indexed investing. But still, trustees do have an obligation to monitor the investment advisors and investment professionals that they have delegated those duties to. And they should discuss with them what options there are for different ways to address climate risk in their portfolio. They should ask them what they're already doing, if anything, to manage climate risks. And they should make clear what their investment priorities are. I know a lot of trustees are reticent to tell their asset managers or their investment advisors what to do because they're the professionals, but the trustees really are responsible for the big picture, broad strategy of the funds, and there can be a real principal agent problem if they don't make those intentions and those goals clear to their investment advisors. And finally, it's worth talking about potential liability. The idea of climate change being a subject of litigation might seem strange, but climate litigation is real, it's ongoing, and it's ever more successful. Just last month, or maybe the end of July, there were 3 new cases filed from California, and it's becoming really clear really rapidly that this issue is justiciable, and it's something that courts can consider. And not just with the $1 trillion transformation project, but a number of independent financial institutions and investment advisors have really put the public on notice of financial climate risk. And these fiduciary duties are legal obligations, and they carry legal consequences, and beneficiaries have real material interest in ensuring that their pensions and pensions for future generations are secure and protected from climate-related financial risk. Thank you.
Great. Thank you both. Let me just get back on the screen here. That was really interesting. So let me just say again that if anyone has a question, you should feel free to ask it in the question function or chat it in the chat box to me, and I will pass it along. And thanks to those who have already. Let me see here. So let's start, Alex, with you. So you described this tool that you've developed. Can you, obviously without getting into specifics, can you talk about, are there pensions that are using the tool, and broadly, what result comes out of that? You sort of outlined different paths forward, and I wonder if you have a sense of, are most people going in one direction, or like what's the result of using that tool, and how much is it being used already?
That's a great question. So in the last 2 years or so, we've done climate risk assessment and risk management strategy exercises with about a half dozen public pensions across North America, so U.S. and Canada. Some of them are public pensions, and I can name them because our engagements with them are known in the public domain. But New York Common Retirement Fund, the Connecticut Treasurer's Office, the CalSTRS, and now New York City, all have engaged us to do some climate change risk assessment work for their defined benefit pension plan obligations, and then to advise their staff and boards on how to manage that risk in a holistic manner. And what has come out of that in some cases is some portfolio decisions have been made. The processes are deliberate in many of these public pension plan contexts, and that's appropriately so, with many decision-making bodies involved in making very careful decisions about moving millions of dollars and sometimes billions of dollars in certain directions. So that's where that comes from. But we had a couple of our our clients allocate to low carbon index funds, for instance, which has the end result of effectively lowering their carbon footprints and their ownership of fossil fuel reserve owners in that segment of their portfolio to de minimis levels, and also keeping their risk return expectations pretty much the same. So tracking error of those types of products doesn't increase versus similarly market cap weighted products. So I think we'll watch this space. There's going to be a lot more movement in the next 6 months to a year, I think, and across the world. And actually, some non-U.S. examples. We saw New Zealand Super just launch a big decarbonization plan just a couple of weeks ago. You can Google New Zealand Super decarbonization or climate change risk management, and you'll get a whole bunch of information there. And that follows on from a number of Dutch pensions and Northern European pensions more broadly that have done similar work in recent years. So there's plenty of examples out there if you know where to look.
Great, thank you. And related to that, the pensions that you mentioned are all relatively large places at the state level or a very large city. So I guess first, do you have, are there examples, even if you can't name them, of sort of smaller entities? And then related to that, are there options? Obviously, I can't ask you to speak to your competitors necessarily, but are there options for local governments that can't necessarily afford to use a proprietary tool like yours or to engage with you? Are there any other options, open source, et cetera? Like, what's the next version if somebody's not able to hire you to do this for them?
Well, I mean, one idea which we've floated before, maybe to the wrong audience, but it is collaborative engagements. Those are certainly valuable. I mean, if you can work together with like-minded peer organizations, you can get some economies of scale and do things that you wouldn't otherwise be able to do independently. So that's an obvious approach. I mean, there aren't too many other top-down climate change risk models in the marketplace that I'm aware of. But there are other means of assessing climate change risk too. I mean, you can use carbon footprinting data to analyze portfolios, and that's pretty efficient to do and cost-wise and resource-wise. And it gives you a different view of the risk from the bottom up. And it has pros and cons versus our approach. And there's just other webinars on that subject in other parts of which you can draw upon. So, but yeah, there are lots of options like that.
Great. And Stephen, I want to get to a question for you, but Alex, let me just follow up with that one more step, and that is obviously most pension boards are going to have somebody who is managing a portfolio for them already. Is this something that most portfolio managers are equipped to do? I think the answer is no, but if a pension board already has a relationship with a manager, how do they go about starting to ask these questions around risk and exposure?
And that's a really great point, Satya. Actually, the easiest thing to do, and maybe the best first thing to do, is actually to survey your existing panel of your service providers, so your investment consultants and your investment managers, and just ask them. It can be one question, it can be several, but ask them what they do to address climate change risk and how they're thinking about that in their advice or in their portfolio design. And if you don't like the answers you receive, then and you're looking to do more on climate change, then it certainly warrants a subsequent conversation and possibly down the line some action to try and change the situation if you'd like that to change. But that's certainly a first step, is to make sure that you understand what your current service providers are doing around climate change risk.
Great, thanks. And that's actually a great segue into the first question for you, Stephen, which is that you outlined a really fairly active role for pension boards and board members. And so I wonder if you have a sense, again, I would assume, but please correct me if I'm wrong, that some of the larger pension boards might have, take that most active role, whereas some of the smaller ones maybe aren't as active. And so do you have a sense of how much are people really living up to that full sense of how active they ought to be? And can you give any examples of places that you feel like or boards that you feel like are doing a particularly good job that might be a place to emulate?
Well, I think one of the key differences too is about staff, in addition to the size of the boards, is that larger pensions tend to just have more employees working for them day to day and have a larger suite of internal operations. I haven't encountered any board members or members of any board where I've thought they weren't, weren't checked in or weren't doing anything. I've definitely spoken to a couple where it seems like they are really doing their homework and really pushing their asset managers and their external advisors. And I think the two examples I can think of would be NYSERS, the New York City Employee Retirement System, and CalPERS, the California Public Employee Retirement System, where they're really doing the diligence. But yeah, I mean, it's definitely hard no matter what, just because these are big organizations and it takes a lot of effort to even steer them a little in a new direction.
And are there, so this is maybe a softball and a chance for you guys to pitch resources that you have, but are there resources out there for pension board members that you think are particularly useful? If pension board members have want to engage with this subject, but for example, their managers are not yet, but they, where do people go for more better information on what they can do as board members?
Well, the first stop should be our $1 trillion transformation report, which I think we'll send around or have sent around as part of this webinar. So shameless self-plug there, sorry. But
I gave you the opportunity.
Thank you. Yeah, that's softball, as you said. But there are lots of other resources online, and I'm forgetting the web page, but we can send it around. But there's a group of investor groups around the world that are focused on climate change. In the U.S. series, the nonprofit series has convened the Investor Network on Climate Risk, and there are regional equivalents to that all over the world that have web pages and have a whole suite of resources that that trustees and staff members for pension plans can rely upon to learn more or to actually do some stuff collaboratively with other like-minded investors. And they've all banded together to create a sort of centralized resources online. And I'll try and find that link and send it around as well. But yeah, there's tons of information out there. I can understand that being somewhat daunting. So I'd suggest starting with our report for ease of cutting off the research.
Yeah, and just to follow up on that, I would say it's really quite an exciting time, I think, because there are a number of techniques and strategies to deal with climate-related risk in a bunch of different ways that are emerging and being tested and being refined. And obviously, I mean, I'm a big fan of Mercer's approach to these questions, but I think as important as, or more important than which, whether it's 2 degrees investing initiatives proposal or its divestment or its whomever's, making a choice to undertake one of these strategies is as or more important than which one specifically you choose. And I think different ones may be better or worse suited to different pensions depending on their size and their current allocations and their needs and their funding levels and things of that nature.
Great. So let me ask you sort of the next step out, and I think this might be getting into the question of plan documents, but again, correct me if I'm wrong, but so we just talked about how the role of a board member But obviously, there's other players in the system here, right? So in many cities, the board is separate from the sort of local governance structure. So there would be a mayor and a city council, and then of course there's the beneficiaries, or those that are future beneficiaries of the pension fund. And so let me ask first on the local government side, if mayors, city council members want to feel strongly about the climate risk question, what can their role be in engaging with pension boards around this and engaging with one of the things you said was you should start by looking at your plan document. That's a powerful way to sort of start to shift the direction of the boat, right? And so is there a way for other folks outside the pension board to engage with that document or to recommend changes to it? Like what's the role of a local government in their own pension funds?
Well, first, I think that obviously varies jurisdiction by jurisdiction, but
sure.
Some general observations. Usually pension funds have public-facing documents, which might be a statement of investment principles, but then they'll have private, internal, more specific documents. I don't know to whom those would be available. That probably depends city by city, whether you have a mayor or a city council kind of setup. But I think most importantly is just the political branches of the government have to talk to the pensions, and the pensions should be acting independently, and not subject to political pressure. But they also, the mayor, city council does also have an interest in the well-being of the pensions and the funding level of the pension and their beneficiaries, having their retirements. So I would say just start by asking and starting a dialogue. A lot of jurisdictions, and it doesn't always get to this level, they have a carve out in their pension laws where they say that either the city council or whatever legislative body runs the municipality does have the right to prohibit certain investments, but only if it doesn't violate fiduciary duties. So at the end of the day, it's all just coming back to this analysis of what is prudent, what makes sense. And I think the mayor or the city council really has the job to make sure that their trustees are awake at the wheel, make sure they're looking at this, make sure they're doing all of the things that we've been recommending.
Great. I have a follow-up, but I just want to say to folks, thanks for the great questions so far, and I think we will have time for a few more if you wanted to enter any others into the question box. But let me follow up on that, Stephen, with the sort of next question, which is the role of the beneficiaries of the pension fund or the future beneficiaries of the pension fund. I think your point is well taken that the board has a duty to the future beneficiaries. What is their role in this question in engaging with a board to raise the questions of climate risk and fiduciary duty and get information about what is being done or have opinions about what should be done?
Well, I think from a legal perspective, I'll start there. In terms of who has standing, and obviously we hope no one ends up getting sued, but if a lawsuit were filed, typically beneficiaries have standing if their pension fund or their benefits have been impaired. So from a strictly legal perspective, their role is quite literally as plaintiffs were something to go wrong. But assuming we're not there yet, I think beneficiaries, the trustees really work for them. And so beneficiaries are oftentimes part of a public sector union, and those unions tend to have union representation on pension boards. But even if they don't, I think the beneficiary's job or their role is really to make their interest heard, to make it clear that a a lot of trustees, understandably, are nervous to institute a new system of analysis or make a kind of fundamental change, even if it's just adding a layer of analysis onto what they already do. And that makes sense. But I think that the beneficiaries really do have the opportunity and have the power to influence the trustees and the fiduciaries of their pensions and say, you know, I am going to need this retirement in 20 years for another 30 years. What are you doing to make sure that I'm protected from climate risk? So that to me, I think just really lobbying their trustees and communicating and making their voices heard is one of the most important parts of this whole ecosystem.
Great, and perhaps to start by making your report available to their pension board members. We have another, I think, really interesting question, and Alex, you laid out a framework of, and forgive me if I don't get it exactly right, but of future takers and future makers, which I think is a very compelling way to think about it. Can you talk a little bit more about that spectrum and where you see, I mean, it may be purely anecdotal, but where you see most pension boards being on that spectrum right now? And then I don't know if we'll have time, but maybe a little bit about, and certainly Stephen, feel free to chime in, how a board or a city moves into the realm of being a future maker. If most of them, presuming most of them are not there yet, you know, what are the things that they can do to put them in that category or to move towards being in that category?
It was a great question. So, I mean, I'd say the most common mode of action right now is to be a future taker, and there are a number of organizations that are toying with the thought of doing something to address climate change risk in their portfolios, which would make them, you know, aware of future takers. But for the most part now, you know, most pensions, by count anyway, are unaware or are just not, haven't risen climate change to the top of their priority list or risk register. And so aren't addressing it at all in many cases. You know, that said, the momentum is certainly in the direction of more climate change related action amongst public pensions across the board, and we're expecting that trend to continue strongly in the next few years. You know, getting to the future maker role, or how you get from here to there, I mean, it takes a lot of governance, blocking and tackling, really. I mean, that's the big heavy lift, is really taking time to understand how climate change influences your investment risks and returns, what the role of the pension fund is to address climate change in its own portfolio and also in society at large. And there are a number of different positions that have been taken by pensions around the world to varying levels of conviction in their role to address climate change. And you know, future makers will typically say that they have an obligation to make sure that the future is habitable for their future beneficiaries, or something to that extent, and that they want to engage with companies and with policymakers to make sure that a 2-degree scenario eventuates, and because that's not only best for financial outcomes in the long run, but also because they believe it's best for their beneficiaries' well-being in the long run. And then they'll do a number of things to see that their portfolio is protected from a 2-degree scenario taking place. For instance, you know, that can cause a lot of fossil fuel intensive assets to be stranded or to suffer losses. And so, you know, they'll want to protect their portfolio from that potential asset stranding risk, as well as while they're advocating for a 2-degree outcome to take place. But to get there, you know, there's a lot of education that needs to take place amongst trustees, a lot of, you know, acknowledgement of the complexity of climate change and how it influences portfolios and the economy more broadly speaking, and getting to consensus around, you know, how the organization should position itself is not easy. So yeah, I wish there were a cleaner and like really clear roadmap, but that's really, it's a lot of talking with experts, hopefully.
And are there any examples of pension boards sort of feeding back to their cities on actions that the cities should be taking? Because it seems like not only is there a role for pension boards to potentially think about how to mitigate climate change, but obviously cities have a big role there as well. And I wonder if there's any feedback from the pension boards to their governments.
I mean, so I'm not sure that feedback is directly correlated, but to sort of, I think to indirectly answer your question, there are a lot of things that cities can do outside of their pension funds to address climate change financially. We're starting to see more U.S. municipalities, for instance, through their treasury functions, issue green bonds to finance, low carbon infrastructure projects. We're seeing, more interest in social impact bonds and other financial mechanisms which are sustainability oriented. And that's something that, treasurers typically, city treasurers do typically control or have some control over, is their bonding capacity and how it's used. There's also cash. A lot of city treasuries sit on, lots of cash, and that cash is typically sitting in, very boring short duration fixed income securities or in bank accounts in some cases, and there are opportunities to do more with that cash from a climate change oriented perspective, and so those are things that, again, that cities can directly control, which don't have to go through the same governance structures that pensions have to go through. That
sounds like fodder for a future webinar. We are at time, so let me say, Alex Bernhardt from Mercer and Stephen Feit from the Center for International Environmental Law, thank you both very much for being with us today and sharing your wisdom. We do have links to the reports available, and we'll send them out again as a follow-up, as we will the recording of this webinar if you want to share it with your colleagues or listen to it again. Or just see the slides. And all this will also be posted on both the Mayor's Innovation Project website and the Efficiency Cities Network website, which chatted out the links in the chat box if you don't already have them. So thank you, gentlemen, both of you again, and thank you everybody on the line for joining us for what I at least thought was a very interesting hour. Appreciate your time, all of you.
Yeah, thank you for having us.